Are we just waiting for Nvidia, Mark?
Unfortunately, we are to some extent, and that's a weird thing to say for a macro guy like myself. Nvidia essentially is one of the biggest macro inputs in global markets now. And it's a hard one because when you come from my background, you're not used to the bottom-up analysis to study these earnings, and yet every single macro trader, whether they're a fixed income guy, an FX guy, a credit allocator, or just asset allocator around the world, needs to care about Nvidia. Even in commodities, they need to care. This is going to affect risk assets. It's going to move stock markets. It's going to say how the trend kind of sets for asset markets around the rest of the world over the next couple of weeks. So yes, we are waiting for it. Now, the backdrop going to Nvidia is very, very constructive. We've got central banks with dovish reaction functions. Growth is not brilliant, but it's okay. It is still doing okay around the world. And that environment of supportive central banks and still okay growth means that it's generally a positive macro environment going into those Nvidia earnings.
Which is great, except for if Nvidia misses pretty substantially. And I'm curious how that shows up or how that has a ripple effect, not just in the broader stock market, but in the broader kind of financial conditions, like how long that malaise could potentially last if we do see a miss, or if this is the time that winning streak snaps.
Yeah, we've been trying to work out kind of what the reaction function here is. I think it's important that Nvidia is so volatile in terms of its earnings and growth projection. It's been moving so fast, I don't mean just the stock price, that I think that if there's a miss that is not crazy, then it doesn't undermine the whole narrative because expectations have risen so high. So I think if we get a miss, we get short-term volatility, we get a bit of a disappointment. But given that we had the July clean out of some of the kind of exuberance already, I don't think it's that bad, and we quickly get back into that bullish narrative. I think for us to suddenly kind of derail stock markets, it needs to be an absolutely humongous miss, a material miss that I just don't see any evidence from, and anybody involved in the tech sector tells me there's no chance of a miss in that scale. Yes, there's a chance of a miss just because our expectations got so elevated, not because the model is suddenly broken, not because the bubble is ready to pop from the bottom up yet.
And Mark, you're flagging concerns about too much expectation going into Nvidia. Is there too much expectation going into the Fed, into the ECB? Where is the market pricing on those rate cuts most out of whack?
Yeah, I think there definitely is too much priced in for rate cuts around the world for the next kind of 6 months or so. The hard bit, though, I mean, I think ultimately we'll see yields trade higher again, but it's a very, very hard trade to have because we know that central banks have a very dovish reaction function, most importantly the Fed. We know that the Fed would cut 50 basis points if they're given an excuse. I just don't think they'll get the excuse to. But that means that every time we get some bad data, we're going to overreact. And we've seen that over the last couple of months. So it'll be a natural trend of front-end yields trying to rise higher over the 6 months, but every time there's a negative shock in the data, they dip really, really aggressively, and that makes it extremely hard to trade.